Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thank you for joining us on this almost fall day here in the Pacific Northwest. School is back in session and parents around the country are happy, certainly, that is happening. Today we thought we'd talk about the recent market action, not only in the stock market and the bond market, but also in other risk assets. And then Josh is going to talk a little bit about expectations going forward. So we've seen a little bit of weakness over the last couple of weeks in the equity markets. I mean, markets are still relatively close to all-time highs, depending on what market you're talking about, anywhere between 2.5% and 4% off all-time highs. So we're not really quite approaching correction territory, but who knows, if markets continue the way they have the last couple of weeks, we could see markets down maybe 10%, which certainly would be healthy for markets. It's not being driven by anything scary. Markets are just sort of trading sideways and then lower into the close, but it's not really driven on any big news that is making markets sell off. So we're also seeing the housing market finally starting to soften a bit. A lot of people couldn't believe what it was doing, and it has certainly softened a little bit. It's still strong depending on where you live, but the crazy frenzy activity we were seeing in the spring of last year into summer has certainly slowed, and we think that's a good thing. Both of those two things, equity markets slowing down from there, it felt like linear move higher. It felt like every single day Josh and I came to the office and markets were higher. It certainly made our job easier, but we knew that eventually it would end and make our jobs more difficult at some point. This is sort of the best sort of circumstance where we get this sort of rollover in markets, but it's not anything drastic. We think that's ultimately healthy for markets, and we expect more of it in the latter half of the year. Who knows, markets are probably most likely anticipating the Fed taper later in the year and potentially interest rates moving higher. Interest rates have not moved higher, but markets are forward looking, and that's potentially what they're looking for. So Josh can talk about what we've seen. Obviously has been unbelievable returns, but maybe what we should think about for expectations going forward.
Yeah, we obviously talk to a lot of clients, and so we feel like we get a fairly good barometer in terms of what sentiment and expectation are. And one of the things that we wanted to highlight is just expectation management, and maybe a little context is helpful. Remember, the S&P 500 is up about 18.5% year to date, which by any measure is a fantastic return on an annual basis, let alone through the third quarter. And even looking further back, the S&P 500 is up 30% over pre-COVID highs. So, armed with all the facts that have occurred over the last 18 months, would you anticipate stocks to be this much higher? Absolutely not. And so, those facts are helpful. And remember, most of our clients at least aren't fully exposed to markets. And with yields in the bond market so low, teen returns annualized over the last 2 years are significantly better than what expected returns would have been with respect to bond yields. And so the other thing I wanted to highlight is just the phenomenon of recency bias. And as Tyler mentioned, as markets sort of levitated to the sky in the first half of 2020, it primes our brains to anticipate further increases in stock prices. And recency bias works the other way when stocks are selling off, like it did in March of 2020, when no one wanted to take any risk for the preceding couple quarters. But remember, manage expectations. Everything's relative to expectation. Stocks, by most measures, are near the highs of valuation metrics, so expected returns should be low, and returns have been so good, we've just been borrowing from future returns, and that's something to keep in mind. And so just know that over the next few months, as we hopefully exit COVID and we start turning to the debate about whether or not rates are going to move higher and how soon, there's going to be volatility to come.
Yeah, so remember, part of our job is to manage expectations, and like Josh said, a lot of the returns that we've seen over the last couple of years are borrowing from the future, and so we just want to manage your expectations for future returns. We can't continue on high teen returns indefinitely because that would be unhealthy for stocks. So as always, if you have questions about your situation or your portfolio, call the office. That number is 800-743-0988, or you can email either one of us at josh@northwestquadrantwealth.com or tyler@northwestquadrantwealth.com, and we'll be happy to talk to you. We'll be back here in a couple weeks.